Open your wallet. Count the cash inside. For most people, that feels like money, something physical, something tangible, something they can hold. Now imagine adding together every banknote, every coin, every piece of physical currency circulating across the entire economy. Surely that must represent all the money that exists. It doesn't. In fact, it represents only a surprisingly small fraction. Most money has no paper, no metal, no physical form. It exists only as digital entries inside commercial banks. Invisible, transferable, spendable, trusted. This creates one of the greatest misconceptions in modern economics. People believe central banks create all the money. Architects know central banks create only one layer. Commercial banks create another. Together, they form a two-layer monetary system, quietly supporting every modern economy. Today, we decode the difference between base money and broad money, why one is created by the central bank, why the other is created by commercial banks, and why understanding these two invisible layers changes the way you see money itself.
To understand the two layers of money, we must begin at the foundation. Every modern monetary system starts with one institution, the central bank. Unlike commercial banks, the central bank creates what economists call base money, sometimes referred to as the monetary base, or high-powered money. Base money consists of two essential components, physical currency and reserves held by commercial banks at the central bank. Notice what is missing: your checking account, your savings account, your business account. None of these belong to base money. That surprises many people, because most people assume the balance inside their bank account was created directly by the central bank. It was not. The central bank creates the foundation. Commercial banks build upon it. Imagine constructing a skyscraper. The foundation supports the entire structure, but no one mistakes the foundation for the building itself. Modern money works the same way. Base money is the foundation. Broad money is the skyscraper. Every banknote in your wallet began as base money. Every reserve transferred between commercial banks exists as base money. This is the money the central bank can create directly. Yet despite its importance, base money represents only a relatively small portion of the total money circulating throughout the economy. Why? Because the purpose of base money is not to finance every transaction. Its purpose is to support the banking system that finances those transactions. Think of electricity flowing into a city. The power plant generates electricity, but the power plant is not every home, every office, every factory. It provides the energy that allows the entire system to operate. The central bank performs a remarkably similar role. It supplies the monetary foundation. Commercial banks distribute financial activity throughout the economy. Most people believe printing more cash creates prosperity. Architects understand that base money alone cannot build an economy. Without businesses willing to invest, without banks willing to lend, without households willing to spend, base money remains only potential. The real expansion begins when that foundation interacts with the banking system. That interaction creates something much larger, something economists call broad money. And broad money is where most modern economies truly operate.
If base money is only the foundation, then where does the rest of the money come from? The answer takes us back to the commercial banking system. Every time a commercial bank approves a loan, something extraordinary happens. A new bank deposit appears. That deposit becomes spendable, transferable, investable. It behaves like money, because for households, businesses, and investors, it is money. This is broad money, not because it is physically broader, but because it includes far more than cash. Checking accounts, savings deposits, business deposits, electronic balances, all become part of the money circulating through the economy. Notice what this means. The majority of transactions you make every day never involve physical currency. When your salary arrives, no truck delivers banknotes. When you buy groceries with a debit card, no cash changes hands. When a company pays its suppliers, the payment moves electronically. When an investor purchases shares, the transfer exists only as digital records. Most modern economies function almost entirely through broad money. Cash has become the exception. Digital deposits have become the rule. Imagine looking at an iceberg floating in the ocean. The visible tip represents physical currency. Small, obvious, easy to recognize. But beneath the surface exists an enormous hidden structure. That unseen mass is broad money, invisible to the eye, yet supporting nearly everything above it. Most people only see the tip. Architects study the entire iceberg. This explains why discussions about printing money are often misunderstood. People imagine printing presses producing endless stacks of banknotes. In reality, much of the expansion in the money supply occurs without printing additional cash. It occurs when commercial banks expand credit. Every new productive loan creates another deposit. Every new deposit becomes part of broad money. The monetary system quietly grows, not primarily through paper, but through digital balance sheets. This is why economists monitor different measures of the money supply. Base money reveals the foundation. Broad money reveals the economy's circulating purchasing power. One supports the system, the other powers the system. Most people think money exists inside wallets. Architects know money primarily exists inside balance sheets, not because paper disappeared, but because modern civilization evolved beyond relying upon physical currency alone. The economy became too large, too fast, too interconnected. Broad money became the invisible language allowing billions of transactions to occur every single day. And without it, modern commerce would slow to a pace the world could no longer sustain.
At this point, a question naturally begins to emerge. If the central bank creates base money and commercial banks create broad money, which one actually matters? The answer is both, but in very different ways. Imagine the central bank suddenly doubles the amount of base money. Most people immediately imagine prices exploding, hyperinflation, currency collapse, runaway spending. But reality is rarely that simple, because creating base money does not automatically create broad money. Remember what we learned in previous episodes. Commercial banks still decide whether to lend. Businesses still decide whether to invest. Families still decide whether to borrow. Confidence still determines whether new credit enters the economy. Without those decisions, new base money may simply remain inside the banking system, unused, idle, waiting. Think of rainfall filling a reservoir. A full reservoir does not guarantee that every farm receives water. Pumps must operate. Channels must open. Farmers must plant crops. Only then does water become agricultural production. The monetary system works in a remarkably similar way. Base money provides potential. Broad money creates activity. This distinction became especially important during major financial crises. Central banks expanded their balance sheets dramatically. Many observers predicted immediate hyperinflation. Yet in several economies,
consumer prices remained relatively stable for years. Why? Because much of the newly created base money never transformed into rapidly expanding broad money. Banks became cautious, borrowers became cautious, investment slowed, confidence weakened, liquidity increased, but credit creation remained restrained. The monetary foundation expanded, the upper layers expanded much more slowly. Most people believe printing money automatically creates inflation. Architects know inflation depends upon where money flows. Money sitting inside reserve accounts behaves very differently from money financing businesses. Money supporting productive investment behaves differently from money chasing existing assets. Money encouraging innovation behaves differently from money encouraging speculation. Direction matters, velocity matters, confidence matters. This is why economists carefully distinguish between the quantity of money and the circulation of money. An economy can possess enormous liquidity while still experiencing weak economic activity. Likewise, a rapidly expanding credit cycle can create inflationary pressures even when physical currency barely changes. Understanding this distinction changes the way you interpret monetary policy, because when headlines announce the central bank created billions, the first question should never be, how much? The better question is, did that base money become broad money? Because only then can new purchasing power begin reshaping the real economy. And that transformation depends upon far more than a printing press. It depends upon the confidence of an entire financial system.
Imagine looking at the monetary system from space. You would not see coins. You would not see banknotes. You would see movement. Two enormous rivers flowing through the economy. The first river begins at the central bank. It carries base money, physical currency, bank reserves, the monetary foundation. The second river is far larger. It flows through commercial banks, businesses, households, financial markets, supply chains, investment, consumption, innovation. This is broad money, the purchasing power that drives everyday economic life. These two rivers constantly interact. One provides stability, the other provides activity. One anchors the system, the other energizes the system. Neither can function effectively without the other. Imagine constructing a modern city. The foundation supports every building, but people do not live inside foundations. They live inside homes, work inside offices, produce inside factories, travel through transportation networks. Base money resembles the foundation. Broad money resembles the city itself. Most people focus only on the visible buildings. Architects study the foundation supporting them. This is why central banks and commercial banks perform different roles. The central bank manages the monetary base. Commercial banks expand purchasing power through responsible lending. Together, they create an architecture capable of supporting billions of daily transactions. Notice another important distinction. The central bank cannot force businesses to invest. Commercial banks cannot force households to borrow. Consumers cannot force banks to lend. Every layer depends upon confidence in the next. Confidence becomes the bridge connecting base money to broad money. Without confidence, the bridge weakens, credit slows, economic activity contracts. With confidence, the bridge strengthens, capital flows, investment expands, innovation accelerates. The architecture begins compounding upon itself. Most people believe economies are powered by money. Architects know economies are powered by confidence flowing through monetary architecture. Money is simply the medium, confidence is the force, and institutions provide the structure allowing that force to move safely across society. Understanding these two monetary rivers changes how we interpret every financial headline, because whenever new policies are announced, the real question is no longer how much money was created. It becomes which river is changing, and even more importantly, will that change reach the productive economy? That question separates observation from understanding.
After everything we have explored, one conclusion becomes unmistakable. There is no single money. There are layers of money. One layer creates the foundation, another creates the circulation. One provides stability, the other provides economic life. Most people spend their lives interacting with broad money, the numbers inside bank accounts, the salaries they receive, the payments they make, the investments they hold. Very few ever see the base money supporting that entire structure. Yet without the foundation, the structure cannot stand. This is why modern monetary systems resemble architecture more than machinery. Every layer depends upon another. Every institution supports another. Every decision influences another. The central bank creates the monetary foundation. Commercial banks transform that foundation into purchasing power. Businesses transform purchasing power into production. Workers transform production into income. Consumers transform income into demand, and the cycle begins again. Money is never the final product. Money is the connector. It links every participant inside the economy into one continuous network of cooperation. This is why architects never ask how much money exists. They ask, how is the monetary architecture functioning? Is liquidity reaching productive businesses? Is credit financing innovation? Are households confident enough to invest in the future? Are financial institutions allocating capital efficiently? Because those questions determine whether money becomes prosperity or merely numbers moving across balance sheets. Most people believe wealth begins when money is created. Architects know wealth begins when money reaches productive activity. Money sitting idle creates very little. Money financing factories creates production. Money financing research creates innovation. Money financing infrastructure creates future capacity. Money financing entrepreneurs creates entirely new industries. The difference is not the quantity of money. The difference is the quality of its destination. That is the invisible architecture beneath every successful economy. And once you understand the relationship between base money and broad money, you stop seeing money as an object. You begin seeing it as a living system, a system constantly transforming confidence into productivity, and productivity into wealth.
The greatest mistake people make is believing all money is the same. It is not. Some money anchors the financial system. Some money powers the real economy. Understanding the difference changes everything. You stop interpreting monetary policy through headlines alone. You begin asking, which layer is changing? Where is liquidity flowing? Who is creating new credit? What kind of economic activity is being financed? Those questions reveal far more than any single statistic. Because economies are not built by printing currency. They are built by transforming monetary potential into productive reality. That transformation requires confidence, institutions, capital allocation, entrepreneurship, innovation, and time. Most people follow the quantity of money. Architects follow the architecture of money. Most people debate whether money was printed. Architects investigate whether purchasing power reached productive systems. Most people see the visible economy. Architects study the invisible layers supporting it. Because wealth is rarely created at the surface, it is engineered deep within the architecture that connects trust, credit, capital, and production. In the next episode, we will uncover the force that quietly erodes purchasing power without changing the numbers in your bank account. A force that rewards some while silently taxing everyone else. It is called inflation. And once you understand how inflation truly works, you will never look at prices the same way again. This is ASUTSEN, Architecting Wealth, Automating Future.